Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest, Matt Williamson. Before we get started, a quick disclosure that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So with that, I will transfer control over to you, Matt.
All right.
And welcome. We're going to talk about the Fruitfly. A lot of people have been following you on your trial, so it's a good chance to introduce yourself and what the trade's about.
Yeah, I'm happy to have a chance to do so. Let's see. How do I share my narrative? All right. Can someone confirm?
I see questions.
Questions at the end. Okay, here we go.
There we go.
All right. So yeah, welcome everyone. Thanks for joining us. Basically, just going to talk about the strategy. I'll kind of give you guys some background on me. Tom already gave the disclaimer for Capital Discussions, but of course, I'd be foolish not to give my own. So all the things that Tom said. And please don't trade if you don't know what you're doing. But please read this disclaimer. I'll just leave it up there for a second. And yeah, we're running the alert service. We just closed our first trade on, I think it was Monday afternoon. We closed a full profit target in just 6 days. It was a successful first trade. We got into another one yesterday, but we'll talk about all that as we go. So. Here's some quick background on me. I've been trading options for about 7 years. Did a fair amount of trading, or more investing before then, just with stocks and stuff. And I was reading a technical analysis book, and in the back of that book there was a bit about what options were. So I read about them and was sort of fascinated. So went through a number of trading phases. I did the newsletter thing. With a few different newsletters and made some money, lost some money. Overall, definitely not a profitable trading experience. And, I didn't have any control over the trading, so the psychology part of it was not enjoyable either. So then I took a little more ownership and got into some value investing with cash secured puts. Was losing less money doing that. I picked a couple of total bomb companies though that really tanked, and that was how I learned that covered calls and cash secured puts are not the safest trade. So I did lose some money there, and it was also kind of boring. Most of the time you're just sitting around waiting for the put to decay. Then went on to some index neutral trading and took a course that was mainly focused on iron condors and double diagonals and sort of mixing a number of these strategies together, sort of trying to build a tent over the market price. I started that in October of 2014, which is not a good time to start index neutral trading. We had a big V bottom that month and lost a little. I think I lost a little bit of money and then made some back. Wound up breaking even, and it kind of scared me off for a little while. So I went back to directional value stock investing, was trading diagonals, and maybe I think some calendars and stuff. Was making a little bit of money, still not quite where I wanted to be trader-wise. And then, maybe a couple of years ago, got into butterfly trading and found the M3 and the road trip and all that kind of stuff, and just much more comfortable, consistently profitable. So I'm in a good place with the trading now. And one of the things I really like to do is design trades and sort of tweak trades and find ways to make them fit with my trader psychology and that kind of thing. So that's sort of how the trade came to be here. Go into full screen mode. So when Dan created the road trip trade, he said this is a KISS trade. And I was like, I don't know what that is. I got to go look up KISS trades. I couldn't find anything on KISS trades. I was very upset. And then I finally realized it was the keep it simple, stupid slogan. So it's a very simple trade. It makes money. It does great. There were a few things that I didn't like as much about it, so I wanted to just tweak them to fit my, again, to fit my trading style. I don't want to take anything away from it. It's a good trade, but a couple things I noticed that in the first couple of weeks of it, it didn't tend to make a ton of money. It sort of took off after that point. So, for me, I like to see a little more action. So what I did was I tried to bring the days to expiration down to 40 instead of starting out at 70. Just to see what would happen. And then what I found was that when I brought the DTE down to 40, I could never get that entry target of the day I mentioned of $1.25. So unless volatility was super high. So what I tried to do was bring the lower leg down an extra 10 points, which doubles the risk. So I thought, okay, I'll just buy half the contracts. And then here's the road trip, and here's the Fruitfly. So you can see the Fruitfly has a little more of a downward slope. There's more risk in it for sure. But the Reg T wound up being the same. But I was able to sort of bring it in closer to expiration that way. And then the third observation is that, and Tom, I know you guys run this service, so I don't know if you do it mechanically now, but when I watched Dan's original presentation, he seemed like he was mostly trading at discretionary.
It's still pretty discretionary, though. We're trying to come up with some rules for it.
Gotcha. So for me, if I'm going to trade something personally, my discretional trading is not good. So I need something mechanical for myself. So I wanted to come up with some adjustment rules and triggers that I could use consistently and backtest and kind of work with it that way. Just because I know I'm not a good discretional trader. So I wanted to make some rules. So I decided to look at theta, since it's an income trade, and that's primarily how we make money is with theta and Vega. So I decided to look at the theta number that we would start with, and kind of was operating under the assumption that, okay, if our starting position is good, then that theta number should be a good thing to keep an eye on. So we use it as a gauge to determine whether or not we are our current position is still valid and good. So that was kind of the launching point for the trade, and it kind of evolved from there. So just one more note here. Again, I said it before, but I don't want to take anything away from the road trip trade. It's a great trade. It's profitable. It's well thought out. It's just it's lower gamma, it's lower risk, and it's just a little slower. And for me, I like to be in and out a little faster. So I wanted to make sure I gave full credit to Dan and to Tom and Dan for running the service and everything. So don't want to take anything away from the road trip trade. It's a great trade. I've traded it myself. Okay, so with all that said, let's dig into the nuts and bolts of the Fruitfly. So here's a quick summary sheet of all the kind of underlying metrics and stats here. We're going to be using the SPX. It's a butterfly. The planned capital, this is the reserved capital for the whole trade cycle, including all the adjustments. There's going to be $4,000 per lot. So it's not a huge capital commitment to trade this. The profit target's 5% on that $4,000, so it's $200 per lot. The stop we'll talk about. It's a little flexible based on what the structure looks like. So it's the dollar amount or the percentage is not a fixed amount. The win-loss based on the back test was 6-1, so you're winning 6 trades for every one you're losing. Average win was 4.3%, average loss 7.2, which gives you a per trade expectancy of 2.6. This is an always-in trade, so you can calculate annual expectancy assuming that you are always in the trade, which puts it around 63%. That's based on all my back testing data. You wound up with an average of 15 days in the trade. And again, if you extrapolate that across the whole year, you can figure out looking at your per trade expectancy and then make an annual expectancy. Obviously, these numbers are backtest numbers. I do trade it live, but actual performance will vary, and this should not be construed as any guarantee of future performance. Here was just the backtest results, and we can go through some of this. I know someone had asked specifically about digging into some backtest results. Here's the year by year. 2014, there was one trade at the beginning of the year in January that took a big loss. I think it was near expiration and just got a huge move down from an unfavorable position in the 10 to begin with. So that kind of skewed that year pretty heavily. And then 2015, 2016 were both very solid years. And another important note: these are unhedged, so hedging should smooth your equity curve a little bit. We'll take away from some of the winners, but should help clean up the losers also. So hedging will obviously change those results. Okay, so we'll go over the rules and then we'll go over some sample trades. The trade starts 30 to 35 days to expiration. When I was originally designing it, I was looking at 40, but eventually brought it down to around 30. If volatility spikes up, you can do this at 20 days to expiration. You can even get sometimes as close as 14 days to expiration. It's kind of a different beast at that point, but usually you're going to be around 30 to 35. It's going to be closer to 35 with the VIX down here where we are, and again, you can move it to 20 to 25 if volatility gets up near in the 20s or so. Let's see. Someone is asking how many events theoretically tested in slide 13. Oh, that's an excellent question. I'll pull up OptionNet Explorer, and we'll take a look at it at the end. I may just circle back to the questions if that's okay. Let's see. Conditions, none. You're always in the market. The trade, it does do well if volatility is falling. So, getting in at extremely low volatility is a little trickier. Sometimes you wind up in the trade a little longer. It still does fine, but optimal condition would be volatility falling. What we're going to do is buy to open a broken wing butterfly as follows. So we'll put the upper wing at the money or slightly in the money. If we're kind of between strikes, I'll tend to favor the strike that's in the money rather than the one that's slightly out of the money. The overall wing width between the upper long and the lower long, we don't want to go less than 80 there. I prefer it to be 100 or more, so no less than 80. The trade we got into yesterday was an 80 wide overall butterfly. And then we want the lower wing width to be 20 points greater than the upper wing width. So the differential on the wing width should always be 20. So that could be a 40-point upper wing and a 60-point lower wing, or like in the case of the trade we took yesterday, it was a 30-point upper wing and a 50-point lower wing. That always keeps your Reg T risk at $2,000 per lot plus the entry cost. So that will keep your Reg T and your planned capital, that will keep it within parameters. And then the entry price is less than $2.50 per butterfly. Okay. So, and when we enter, what we're going to do is write down our starting theta value. I mentioned that we're going to be using theta to kind of as our adjustment trigger to track when we need to do things. So we'll write down the starting theta value at the current price. So whatever your entry price, just take a look at your Greeks, mark down your theta, and just round it down to the nearest whole number. I do this for a one lot, so theta is 9.3. I'm just going to call it a theta of 9. So when you scale up to a 10 lot, instead of rounding down to the nearest whole number, you have to round down to the nearest multiple of 10 in that case. So, in the previous example, I said theta was 9.3. So if you're doing a 10 lot, theta is going to be 93. So you would round it down to 90 in that case. If we're starting lot size of 12 and a theta value of 129, the theta trigger would be 120 because you're rounding down to the nearest multiple of your lot size of 12. Hopefully that makes sense. Basically another way to think of it is just think of it as you're trading a one lot, round it down to the nearest whole number, and then use that times your lot size to get your theta trigger. Okay, if you can't get the 250 on entry, if you're out 30 days to expiration, you're trying to put together a butterfly, you can shrink the wings. So instead of doing 35, 55 wings, you could do 30, 50. Again, I don't like to shrink it any smaller than 30, 50. You just don't give yourself enough room to the downside if you do that. So that would be number 2 here. Keep the days to expiration the same, but shrink the spread. Number 1, you can keep your strikes the same, but go further out in time. So I always prefer to do a 40-point upper, 60-point lower, or greater if I can. So if I can't get it 30 days to expiration, I'll go out 32, 34, 35. We have so many expiration cycles now, we can kind of tweak that and fine tune it a bit and dial it in. If you can't get it, I would say you're almost never going to be able to not get a 250 entry going all the way down to 30 points on the upper and 50 points on the lower. But if that happens, volatility's just got to be crazy low, or maybe you're using an underlying that's a little bit lower in value. Like if you try to do this on the Russell, you may have trouble with that wing width. Weekly expirations, do I have any liquidity concerns? Someone is asking. No, I mean, it depends on how huge you're going. If you want to trade 10,000 lots, yeah, there may be an issue. But if you're doing it in relatively small size, there shouldn't be a liquidity issue. You can also wait for volatility to increase. That will bring the prices down. So there's your 3 ways to get your entry costs. Okay, once you're in the trade, and again, once we go through the sample trades, this will all make a little more sense. We're going to watch our theta, and if our theta value falls below our starting theta value or our theta trigger, we're going to take the short strikes of the butterfly and roll them up by no more than 10 points to bring that theta number back over your threshold. If you take all of your shorts and roll them all up 10 points, that will max out your planned capital. So that's kind of your, that's your adjustment limit. You can take all your shorts and you can roll them up as much as 10 points without blowing out your planned capital. Okay, if we do that and price later whipsaws back down and closes below that upper long, we're going to reverse this adjustment. When we do that, we set a new theta trigger. We look at what the theta value is 5 points over the upper long, and we will mark that as the new theta value. I believe someone asked how many adjustments per average on trade. Don't know that off the top of my head. We can pull up the backtest log and check the commissions. That'll give us a decent idea. Let's see. Adjustment trigger number 2. If delta becomes greater than -5 per lot to the upside, so if you're to the right of your tent and delta is, I say greater than -5, I just mean absolute value here. So if it's -6 or -7 or -10 or any number over than 5, you're just going to make the same adjustment. You're going to roll the short strikes up 5 or 10 points to correct your delta. If we get whipsawed on this one, we're not going to reverse this adjustment later on. Okay, we'll just leave that alone. Typically, if you get whipsawed after making this adjustment, you're pretty delta flat anyway. So the point of reversing the adjustment for the theta up here is to keep your delta from going too much in the positive direction. So when you make the adjustment down here, your delta will tend to be flat, even if you go back inside the tent. Okay, so all that upside management, the downside management is nothing. Okay, you have an exit point. If we blow out of the left side of the tent, we're going to get out. Okay, so speaking of exits, we are going to exit a profit target, obviously. I only check this trade at the end of the day. Some people like to put a get to cancel profit target order in. You're certainly welcome to do that, but I'll find sometimes that by the end of the day I've hit considerably over profit targets, so I prefer to collect the extra profit rather than get out early, but it's kind of trader's choice there. You're also going to exit if the T+0 is, I think someone else was confused about this. It does say below the expiration line, which it'll pretty much always be below the expiration line. What I mean is to the left of the expiration line on the downside of the structure. So when let me just cycle forward. So if you're over here and your T+0 line hits this point or is over here, that is your exit point. So as long as you're to the right of this line over here, you're still in the trade. Okay. And the last exit is if your trade calls for an adjustment and you don't have the planned capital to make that adjustment. So if your theta has dropped below the threshold again and you've already rolled your shorts up 10 points, the plan would call for you to adjust it to fix your theta, but you can't do it without exceeding your planned capital. That would also be an exit point. And usually you're exiting profitably at that point. And last but perhaps most importantly, if you're not sure what to do in a given situation, exit. If you're not sure what the trade plan means or you're not sure what to do, it's best to exit, in my opinion. I've done it before. I've traded, I think it was in M3 the first time I traded in M3. I was just a little shaky on the plan and got to a point where I wasn't quite sure what I should do, and I decided that I'd rather exit at scratch rather than kind of blindly try to deal with things or fix things. So if you're unsure, exit. And as a side note here, I'm extremely responsive to chat and communication. So if you ever have questions about what you're supposed to do next, feel free to just send me a message or an email or something. I'm happy to help. Okay, let's maybe pause for just a quick second to address some of those questions before we go into the sample trades. I think someone had asked about average adjustments. Let me go into the backtest results. All right, so if we look at the commission numbers, these are all one lots. So let's see, and the commission set to $1.25. So anything that's $10 over here would be a no adjust trade. $15 would probably be a, let's see, maybe a one adjustment trade with some verticals or something. So you just need to trade one lot, Ed, so no more than one. And you can scale up as as high as liquidity will allow you. So again, I don't have the actual number, but we can just sort of look here and get a fair idea. I would say, if I had to guess, most trades are, one or two adjustments. Sometimes it'll go to 3 or 4. You might be making an adjustment and then reversing it, and making an adjustment and then reversing it if you're getting whipsawed all over the place. But probably not more than 3 or 4. Any other questions that I need to address?
A couple. Bart asked about liquidity.
Yeah, I think I mentioned, as long as you're not going crazy in size, I don't think you'll run into liquidity concerns. I mean, I think I've even done this on the Monday and Wednesday expirations. Would you consider tweak expirations if they don't overlap with Dan's road trip or Jim's Kevlar? I don't have access to those alert services, but
I can take care of that.
Yeah, I can try it. We have so many expirations now. I can probably just push it a day or two if I'm stepping on an expiration, so I'm happy to do that. I saw 812 days in trade. Yeah, that's probably a mistake. Where is that? 812 days in trade. Yeah, these are trades that I was testing in a hedge, and I just haven't closed it. You can see it's still open, so that's why it's showing 812. Let's see. I was just really trying to scrape out a win on that one. I've been in it 3 years trying to bring it back to. So let's see, events. Okay, so someone asked how many trades. This is 111 backtest trades. So that's your sample size. Okay, I think that is software you're using, please. This is OptionNet Explorer. It's similar to OptionView. I like it a little better, but similar kind of idea. Okay, so we'll go to the sample trades, and if you guys have more questions, I see there's one trade, P&L minus 42%. What happened with that trade? That was the one trade in 2014 that I mentioned. If someone will remind me, we'll go back to this trade, and I'll show you guys what happened at the end once we've been through a couple sample trades, so you can understand the adjustments and everything a little better. So someone remind me when we finish. Okay, sample trade number 1. This was 7/12, mid-2013, so a very bullish market. I believe I had been calling the top of the market since 100 points before this. And we had to go down to 30-50 wings to get our entry price. Okay, so here is the entry. Let me go back into full screen mode here. Okay, so here's the entry. I did forget to mark the entry price. I think it was about 2.25 or so for this butterfly, but we had the 30-point upper wing and a 50-point lower wing, 35 days to expiration. Our starting theta was 9.4, so again, we round that down to 9. And if you were doing 10 lots, you would round it down to 90 from 94. Okay. And let's see, okay, so this is 3 days later. I think we entered on a Friday. This is Monday. So theta has fallen below the trigger, and the trade is quite profitable already. One thing to note here, if I go back, OptionNet Explorer tends to underestimate the profit on the upside and overestimate or underestimate the loss to the downside. Am I saying that right? So I know that if I move up, I'm going to do better than this line shows, and if I move down, I'm going to do a little worse than this line shows. If you're doing this with option view, I think the T plus 0 line tends to be a little more accurate, so just something to think about. And if you're concerned about Greeks, you can always just use the toss Greeks. So this is the same Greeks as the individual implied volatility as toss uses. Okay, so the first adjustment, market ran up about 8 points over the weekend, so theta has gone below our trigger point. So we're below 9, so we'll need to roll some of the short strikes forward. So our short strikes are at 16.45, and we could optionally hedge this, either downside risk on the whole trade, or you could hedge it as it goes up. There's what the adjusted trade looks like. We took the 16.45s and rolled one up to 16.55 and one up to 16.50. Now, if you guys look at this, this is a very bullish trade now. We're positive 7 delta on a 1 lot. I would probably hedge this, very significantly. And I have more slides that I'm going to be doing in the that I'll post into the alert service. I'm not quite done with them yet. I'm doing a whole course in video, and one of the videos is going to be on different ways to hedge this. So I do have some slides. They're not quite ready to go yet, but there's a number of ways to hedge this. So because I realize this is more bullish than I'm comfortable with. Okay, but that's what the trade plan calls for in terms of an adjustment. Another quick note here. I know option view does this differently, but option net export just puts your closed P&L up here. For our purposes, this is our current P&L. This is just whatever gets closed. So for me, this number is really meaningless until the whole trade's closed. I just only watch this number over here. Okay, now if we left it alone a week later, market continued heading up, and we hit the profit target of $200, mostly from the bullish delta, probably a little bit from the Dago as well. So SPX returned 1.2 over that time, and the Fruitfly brought in 6.8. So that is the end of that trade. It's pretty quick trade cycle. Looks like 7 days in the trade, and the trade goes bullish quickly in a bullish market and takes advantage of that run up. Okay, so that would be the end of the first sample trade. Any questions on that one?
It doesn't look like it.
Okay. So number 2, this was early-ish in 2014. Still in the bullish market. We had just got a little pullback. We were looking a little bit toppy, in my opinion, but as I mentioned, I've been calling top since 1550, I think. So I have a little asterisk here. My market directional opinion is really would be worth its weight in gold as a contrarian indicator. So if I could sell my directional opinion, I would sell it, because you should just do whatever the opposite of my directional opinion is. So I was calling tops here, but I don't trade on my directional opinion. I'm really bad at it. So here's the entry we took. Pretty flat delta and gamma. Theta would be 7, rounding that down to 7. Still had the 30-point upper, 50-point lower. Vol is still pretty low at this point. So entry price was $1.40, so we could lose $1.40 to the upside if we did nothing, or $21.40 to the downside. Okay, and then 14 days later, so we just kind of hung around probably in this neighborhood for a couple of weeks, and then I think we got a pretty big up move this day, if I remember correctly. Yeah, my opinion was wrong. We rocketed another 2% up. So what we'll do is, once we're at this point, we have 2 issues. We have our delta is over -5, it's more than -5, and our theta has fallen well below 7 at this point. So we have to adjust to fix these 2 numbers. If I ever get into a situation where both the delta and the theta need to be adjusted at the same time, if we get the close below this upper long, I mentioned earlier that we would reverse the theta adjustment. But since we're adjusting due to delta also, if we do get a close below our upper long after we make this adjustment, we will not reverse it. Okay. So if we roll our shorts, we have 2 shorts here at 1830. If we roll them, if we roll 1 to 1840, that fixes our theta, and it also brings our delta back down. So we have fixed both issues. Trade looks good here, and that's all we would do. So we go forward one more day, and some profit came in, and our theta is back down below 7. And I may stop here for a second just to say that if you're not used to using theta as a trigger for an adjustment, your theta is basically tied to P&L. So as this P&L number goes up and down, your theta is going to change. You can think of it this way. You know, if you're under the tent over here, your theta is basically just a calculation of how many days the line has to go from here all the way up to here. So if you're here, your theta number is going to be different than if you're here. So it does change with P&L. So between the previous day, which was here, and this day, you know, we saw a profit jump from $30 to $85. So that's why that theta number dropped. So our theta trigger is down below, so we can roll our 1830 up to 1835, and that fixes our theta. So now we're back in business on our theta, and we now have no loss trade to the upside, so we're safe to the upside, so no trouble up there. And then let's see, how many days later is this? 4 days later, we reversed back and closed under this upper long. So we'll need to reverse the last adjustment that we did due to theta. And I treat this as a let's flatten the delta back out kind of point here, rather than just saying I'm going to reverse the last adjustment. I'll reverse the last 2 adjustments. I'll reverse half the last adjustment. I'll kind of do whatever I need to do to flatten this back out. And I think with this trade, you're 11 days to expiration. You know, you've got basically a flat trade on your hand. If you reverse the adjustment, you're essentially resetting the trade. So here's bringing the 1840 back down to 1830. So at this point, you're starting the trade over. In many cases, it would probably just be prudent to push out back to 30 days and restart the trade. You know, for me, this is like entering the trade at 30 days. I mean, at 10 days rather than 30. So, but with a much better upside picture than you would usually get if you're entering that soon. So, just something to think about. If you're this close to a flat trade, you may just want to push out and reset. Okay, but since we did close below the upper long, we have to reset our theta trigger. So you can't see it on the slide, but what I did is just move over 5 points from the upper long and take a look at what the theta says down here. And what it gave me was 23. So our new theta trigger is 23. And then we go forward 2 more days. Oh yeah, 2 more days. Got whipsawed. Market ran back up pretty hard. So our theta number is way too high, and our theta number is too low, and our delta number is way too high. So we would need to adjust again. It's 9 days to expiration, so most of the credit is gone in the shorts. And I've got a note here. I would probably exit at this point just because we're so close to expiration. But to show what we would do if we tried to stay in, we would probably just take all of our shorts and roll them up to 1840, just like this. All right, and when we do that, our theta number looks great. Let's see. Why am I like this? All right, hang on. So theta is not over. Oh yeah, okay. Sorry, I forgot our theta threshold was 23. So since our new theta threshold was 23, we couldn't get back over 23 by rolling all of our shorts to 1840. So per the third exit rule, our trade calls for an adjustment to bring our theta back over the trigger. We can't do it without using all of our plain capital, so that's an exit. Okay, so we would get out. Obviously, we didn't hit our profit target, but we did not take a loss. So that would be our exit point for that one. Any questions on that one?
I don't see any.
Okie dokie. I think that was the only 2 sample trades. What we could do at this point, if you guys want, we can go through just do a back test, and someone can throw out a date. We can do one, do kind of a live back test on one trade. Would that be a good idea?
Yeah, I think that would be very helpful.
Okay, great. Let's do that. I think Ray said January 24th. How would you change this trade if you put 6,000 as planned capital instead of 4,000? I'm going to circle back to that question. Okay. All right, I saw Ray say January of 2014, so we can do that. Oh, this is that big loser. You know what? Let's circle back to the, well, yeah, let's circle back to the big loser, Ray. Non-reversible delta adjustment plans. I'll circle back to that question too. Yeah, let's just walk through a trade or two, and then we'll hit the specifics. All right, so I'll choose Monday of March in 2014. I always use 30 minutes before the close to do my entries and adjustments and everything, so I'll use that same time here. Okay, so I'll go out to 32 days to expiration, and just to set the trade up, my upper long is going to be at the money here, so we're at 1858, so I'll do an 1860. And I always try to do a 40-point, a 40-point upper wing and a 60-point lower wing, so that would put us here. And if we try and enter that trade, it's over our 250 target. So we could either go out further in time. Let's just show you kind of what that will do to the price. What was the price there? 395, 355. So if you go out an additional week and do the same strikes, that brings your price down to 240. So you could do that. You know, that's more than 35 days to expiration. It's just going to be a slightly slower, slightly safer trade. So that's the trade-off. You get a little less theta, a little less gamma, but a safer trade to the downside. So, but I'm going to do it at 32 days, and instead of a 40-point, let's go with a 35-point, and then a 55-point lower wing. So that gives us a $2.10, a $2.10 debit. Bart says, please explain the 250 entry rule. It's basically just to, what I found is if you enter with more than a cost of 250, your upside, let me zoom this in a little bit, your upside dives down too hard into this side, so it becomes hard to pull profitable trades out of the upside. That's basically the idea. Boy, the trade looks much better at 340%, isn't it? Okay. All right, so this is within our target here, so we will enter that. And okay, so when we enter, we'll look at our theta number. Our theta number is 9, so we just want to keep that number over 9, and we want to keep delta, you know, quote unquote below -5. And I just check the market every day around 2:30, so we took a move up, and just to kind of go over this again, our line, let's see how well our line projected this, 1871, basically flat. So if you look at the opening position and scroll over to 1871, the model has us losing, you know, 17 bucks or so, and the actual P&L is, you know, basically flat. So Option Net Explorer does undershoot the upside. Your upside is going to be better than what the model predicts. Okay, but anyway, we are under our theta trigger of 9, so we've got to take some of these short strikes and basically move them up. We can move as many as we want up to a maximum of 10 points. I try to do the minimum adjustment, so something like that. That doesn't quite get us back over 9. That doesn't quite get us over 9. So we could do something like that, which will put us back over 9. Okay, so that's the minimum adjustment I can do to get back over 9. And what we've done is, you know, basically converted the trade to a, you know, more of a bullish trade here. I don't know what the price chart looks like. So we'll go for another day. And we have, oh, you're kidding. I don't have a rule in here to deal with what happens if you close exactly on the upper long strike, but why don't we do this? Just in the interest of safety, let's reverse our last adjustment. Okay, so we'll reverse the last adjustment, and we will take a look at our theta 5 points from the upper long. Zoom way in here for a second. So upper long is 1860, so we'll go over here to 1865, and it looks like our theta is 8 there, so that'll be our new trigger point. Okay, so we'll go forward, and we're still over 8, so we're okay. Still over 8, so we're okay. Still over 8. Still over 8. Our delta's starting to creep up. And the trade has charm, which if you're not familiar with charm, it just means that you're over. It's the accumulation of delta, basically, or the change of delta over time. So if you're on the right side of the tent over here, what's going to happen is your T+0 line has to eventually catch up to this expiration line. It's got 23 days to do it, so it's going to have to keep getting, more and more, steeper and steeper. So as you cycle the date forward, if you watch this delta number day by day, it's going to get more and more negative. That's called charm. So it's a decent idea to be aware of what your charm is, so that you know that your next day you're actually going to have a little more of a negative delta than the model showing. At any rate, we're still over 8, so we'll keep going. Okay, we're inside our tent, still over 8. Still over 8. We're still over 8, but we've hit our delta limit of -5, so we'll roll some shorts. And this is kind of a discretionary moment in the trade. You can roll all of your shorts up and just flatten out and get bullish if you want. You can roll half of them up. You can kind of make whatever adjustment you are comfortable with. I'm just going to roll one up 10 points here. And again, if we close back below the upper long at this point, we're not going to reverse that adjustment. If you look down here, our delta is pretty much going to be flat when we do that, so we're not going to need to reverse it to deal with any potential overly bullish deltas. Okay, now we're under 8, so we would need to roll another short. We're under 8 again. It's probably going to be an exit. Yeah, if we roll our last short forward, we can do that, but we don't get ourselves back over 8. We are at our $4,000 planned capital limit over here. So the only way to really pull in more money would be to start really trying to juice it and do some capital preservation techniques and stuff. But you could do that, but I found that it's not worth it to stay in at that point. So this would be my exit point. Okay, so not a huge winner there, but certainly not a loser. And it might be worth pointing out too. I go back to a few adjustments here. Yeah, if we go back to where the trade closed at 1860, if you had not reversed your adjustment, you probably would have done a little better there. But hindsight's 20/20. We live with what we do. Cool. So that would be one sample trade. All right. Does anyone else want to see another sample trade before there were a few questions that came in that I wanted to answer. Always use mid-price. Any room for slippage? Yes. Oh, sorry. That was this. Yes. Yeah, I use mid-price in OptionNet Explorer. You can generally be patient with your adjustments. More often than not, you're adjusting from a profitable position. So, go in at your adjustment time, put the mid-price in, and if you can't get filled, sure, you may have to give a nickel or 10 cents. Most of the adjustments are vertical, so they're not super difficult to get filled. Usually, it just takes giving a nickel to the market makers for them to fill you. Tom, I thought you were about to pipe in with something.
Oh, just that people always like to see extra walkthrough examples.
Okay, let's do one more, and then I'll circle back to all the questions.
Yeah, I think we have time.
Anybody else want to throw out a date? January 2014. Okay.
There we go.
2316. Everybody always wants to see the crashes. I can tell you though. Let's do we'll do the January trade, but in a I'll set it up and then I'll tell you what the crash trade looks like. All right, so I'll go out to 29 days to expiration. We did get a little bit of a volatility pop today, so entry pricing may be a little better. So let's see if I can do the 40-point upper wing, 60-point lower wing. No, really bad pricing. All right, so I will shrink it. I'll try 35, 55. Still don't think it's going to get there. Nope. Okay, so we'll go down to 30, 50. All right, that gets us in under our target of 250. Okay, so our theta trigger would be 8. I think you guys may see a blowout exit. This may have been a, I don't remember when the entry date on that trade was, but again, if we hit this point over here, that's our exit. So, you know, at this point in the trade, it'd be a $313 loss plus however far we went past the 10 there. One standard deviation up or down, do anything different? I don't. You know, usually you get better pricing on a red day over here on a -1 standard deviation or more, but in this case, really at pretty crummy pricing. So I think volatility must have just been pretty low. Yeah, I mean we were down here in the 10s. So okay, so theta triggers 8. Let's just walk it through. All right, so we dropped below immediately next day. So we'll roll one of our shorts, just 5 points. Looks like it gets us back over our threshold here. Okay, we closed below our upper long, so I'm just going to go reverse it. And go 5 points over the upper long here, so 1835 gives us a theta of 9. So we'll keep this over 9 from now on. All right, we're back under 9. Let's make that same adjustment again. Still under 9 here. All right, over 9 rather. Still over 9 here. Still over 9 there. All right, we're back below our upper long here, so we'll reverse that. Okay, so our new theta trigger is going to be 14. There's 1835, which is 5 points over the upper long. So I got to keep this over 14 from now on. Ugh. Okay, so I've got to do that to get it back over 14. Okay, I'm back under 14. And I'm out of planned capital now, so if we keep going up and have to get back over 14, that would be an exit. But I suspect I'm going to get a move back down. Nope. All right, cool. So I'm back under the upper long here. So I basically need to do whatever I need to do to flatten my deltas out. So I might just do, I'll try and take the worst adjustment I can here, because I think the market's heading lower. So I'll try and do that. And my new theta trigger is 28. Okay, so I gotta keep this number over 28. Oh. Now we're still in the trade here, according to guidelines. We're not going to exit till right there. So theta is still over 28. Theta is still over 28. Our exit points were right over here. Okay, still okay. Now, I should point out that if I were trading this live, I would be well out of this trade. I don't like taking these things this close to expiration, probably for this reason that we're about to see. Yeah. So you're to the left of your expiration line, so that would be your exit right there. Any questions on that one? That was a good example. I got whipsawed around a lot, had to reverse some adjustments, reset theta triggers. It's kind of a good trade to see the mechanics of it. Obviously, that didn't work out well at the end, but all right. So no questions there. I'm going to go back to the chat to see if I can answer some questions. Okay, let's see. All right. Okay, so we just went over the P&L minus 42%. Yeah, Tom?
There was a question I'll paste it in the chat that somebody sent privately, I think. So if you are sending a message, make sure you send it to all participants and we can all see it.
Gotcha. All right, so I'll just go through them chronologically here. How would you change this trade if you put 6,000 as planned capital instead of 4,000? You know, if you do that, you could potentially have more adjusting capital to roll up. What I would probably do instead, I don't know, I'd have to think about that one. I mean, that may turn into a whole other trade, but yeah, I'd probably just reserve. Actually, I have a version that uses 3,000 in planned capital that involves some call spread hedges, so I'd probably just trade 2 of those. I don't really like it. I don't like having risk on both sides of the market, but that's probably what I would do. Can we go over the non-reversal and delta adjustment that's required at the same time? I'll just kind of explain this again. So if you're adjusting due to delta and theta at the same time, when your price goes back into the tent, just reverse, you know, basically just undo whatever adjustments you need to flatten your delta back out. So in other words, the delta adjustment trumps the theta adjustment. So if you make the theta adjustment and close back in the tent, you know, reverse the adjustment. If you make the delta adjustment and you close back in the tent, you know, flatten out your deltas if you need to. If you make an adjustment for both, flatten out your deltas if you need to. I hope that addressed that question. Where and when will the Fruitfly course be announced? As soon as I finish it, I'll announce it. You know, we're basically trading the same. It's the same trade in the alert service. Will the alert service trades include a hedge when you feel it's appropriate? If so, will that increase the planned capital over 4K? Let's see. Yes. So if I feel that a hedge might be prudent, I will include all the hedge options. I think I've got basically 3 different options that you can look at, and I'll take the hedge if I feel that it's prudent. But even if I don't take the hedge trade, I'll post the trade in the chat. And so yeah, the alert service, part of the alert service is a chat room that I'm running right here. So yeah, I'll post alerts and potential hedges in the chat also. And that will not, the hedges do not push the planned capital over 4K. Unless you use a back spread, that is one of the hedges. That if you're using Reg T, I believe you can do it in, like on ES and use span margin, and you can keep your planned capital under 4K because it's leveraged. But that would be kind of a separate conversation. The other two hedges do not increase your planned capital over 4K. If you stretch the graph, the trade will look much better. Yes, always stretch your graph to 500% and give yourself a psychological edge there. Bart, I answered that question already. How do you close these trades out as a package or with verticals? I always close them out with a condor or a butterfly. If you're moving half of the, let's see, if you're moving half of the shorts around at a time, either half or all of the short strikes around, you shouldn't wind up with 5 strikes in the trade. So you can close it all out as a broken condor. I find when I try to get verticals, I always get screwed more than once on the slippage. So I always do better just to close it out as a condor and give the market maker, 5 or 10 cents and try and get out that way. Same thing here. I don't account for slippage in the back test, just because I can usually get in at the mid price, and the only time I wind up with slippage is on a vertical or something, and it's usually only a nickel. If you roll a short for adjustment, have you closed the trade? Yep. Condor or butterfly. How you hedge? This is something we'll talk about in the alerts. I think we're probably pushing close to the end of the presentation, so I won't be able to get into it. But in short, when you make the adjustment to the upside, when you're rolling the shorts, you can at the same time put on a teeny to hedge your downside, a put vertical in a closer month to hedge your downside, or a closer expiration to hedge your downside, or a back spread in a further expiration to hedge your downside. And in all those cases, you still keep a no loss to the upside, or keep your upside very limited in terms of what you can lose. Ray, nothing different here on a plus or minus 1 standard deviation up or down. Office market crash. Yes, this is currently non-functional. The website is not ready for public use yet. There's still lots of broken links and stuff that doesn't exist all over the place. So I'll give you guys an update when the course is available. Nice. Do you have any fail-safe exits based on vol changes? I do not. Do you have any backtested metrics? Seem like you will be hit very big a few times. Just from you, Tom?
Oh, yeah, that was the one that was sent to me privately.
Oh, okay.
Yeah.
What kind of metrics is this person looking for? Just wins and losses and stuff? I can show you guys that.
Yeah, I guess maybe win percents, loss percents, that kind of thing.
So here's 2012 to current. So 111 trades, 11,000 on 4,000 planned capital, so that's almost 300% for those 4 years. 92 winners to 17 losers. Win to loss 5.4 to 1. Yeah, I mean, there's that largest loser that you saw. Average loser is 286. Average winner is 173. But your win to loss is like that. So, again, I'm a big fan of expectancy. So as long as the positive expectancy is there, that gives me the faith to position size accordingly, and just let the numbers play out. So. Do you ever consider reducing the lower leg of those moving prices inside of 10 instead of moving the shorts? I have, Antonio, do you mean reducing in quantity or rolling it in? Not sure which one you mean. I know you could roll it in as sort of a, kind of a defensive move, the lower leg reverse Harvey. But no, I don't do it. I've done similar things on other trades too. So I guess that is it. Let me go back to my slides here. Yeah, here's the link for the trial. What's included: SMS, email, alerts. Every time we finish a trade, we'll do a recap video. I'll do a weekly just kind of update. Here's where we are video. Thank you for posting the link, Tom. And again, there's that live chat room. If you do want to get in the chat room, what you have to do is just send me an email with your Skype name, and I will add you as a contact. Once I have you as a contact, I can put you in the group. If you have any questions, there's my email address. And I think that's it for me.
Nice timing. We're right at an hour.
Thanks. I teach for a living.
Like you planned it.
I have a very good sense of flow and timing in my teaching. I have to be right on the money every time. So.
Excellent. Well, thanks, Matt. It's a great trade, another variation of a road trip, essentially, which is also another good trade. So look forward to people trying out your service and following along. I think plans are what, maybe mid to late January, you'll flip the switch and make it paying, but until you do, then it's free, so no risk in people giving it a try.
Yeah, the risk reward probability factor on a free alert service very, very high.
Yep. And yes, John, I will be putting this recording up on the site shortly. Oh, and Ray wants to know what you teach.
I teach guitar for my day job. Although I'm switching to trading full time, so I'm not teaching as much guitar, but I find that to be very fulfilling, fun work, and I enjoy it. So I certainly won't give it up altogether. So.
Maybe you should do some music for your video intros that I do.
That's a great idea.
All right, Matt. Well, thanks very much, and thanks everyone for joining. And have a happy Christmas if you celebrate that, and if not, enjoy the holidays. It's a nice, quiet time for family and friends, and have a good New Year's as well. So, thanks, Matt, very much. We appreciate you coming on.
Yeah, thanks everyone for listening. Thanks, Tom, for having me.
All right, take care, everyone.